Welcome to this Diwali special. A remarkable fact of the Indian capital market over the past few years is the rise of the private equity and the private credit market. What was earlier largely a foreign venture capital market is now becoming domestic heavy with the rapid growth of family offices wealth and ultra HNIs. Today I have with me two stalwarts of this private capital market, S Sriniwasan, the Managing Director, Kotak Alternate Asset Managers Limited, and Renuka Ramnath, Founder, Managing Director and CEO of Multiples Alternate Asset Management. Welcome, both of you. No one understands the listed space as well as you guys do, since obviously companies that you nurture are brought to the IPO market and everyone's made money lately. It's not so much promoters coming and raising money from the equity market as much as private equities seeking an exit in the stock market IPOs. So straight away that question to you, Renuka. How does the market look? Recent IPOs, I mean, Hunasa also has got very good subscription. Cello has listed at a 28% premium. And EMS and all are like still made a lot of money for investors as well. Is the market still good? Or if you want to list now, you would hesitate a bit. Is it a bit frothy now?
No, I won't say it's frothy at all, Latha. These are all profitable companies, companies which are very well managed with very good governance. I think taking a company public in India, the regulations have become very stringent. The disclosure norms are about the best that you can see in the world. And I think the quality of research and understanding of the businesses is also very, very strong. So I would say that this trend will continue, and we'll continue to see, IPOs of very good companies coming into the market. But valuations themselves, it's a function of the appetite of both domestic and international investors. But what's very interesting for India is the growth in the domestic mutual funds, the kitty, and financialization of savings that has happened. And this is a very, very long-term trend, which is going to serve both the investors and creation of companies, support entrepreneurship, employment generation. I think it's a very beautiful phase of virtuous cycle that we are in.
No, I'm coming to that in a bit on whether we are at an inflection point in the financialization of capital markets. But before that, Srini, for the immediate stock market investor, is there any red flag, or are there too many red flags? There will always be red flags, but are the reds, outnumbering the greens, or do you think, no, the global scare is over and done with, and now we are on a clean wicket?
I would say, if anything, the red flags will come from the external environment. In the domestic environment, I think things are reasonably looking fine. Obviously, you have to do your homework with regard to, which particular IPO to subscribe to or which particular company to buy to. I always give the example, please spend the same amount of time that you would do when you go and buy that television during Diwali, that you go to Flipkart, Amazon and your nearest retailer and then compare the prices and buy. So when you buy your stock and you make an application for a few lakhs in an IPO, at least spend the same amount of time so that you don't make any mistakes.
I think you watched the Rahul Dravid ad. Okay. A similar question to you. I mean, since you spoke about the longer term, there are a few red flags in the economy. Yes, clearly the fastest growing large economy. But, we just had Fitch saying that the potential growth of the economy is much lower, or at least lower than what it was pre-COVID. And then we have instances, more money being asked by the MNREGS. Looks like, at the bottom of the pyramid, more money being given, free grains. At the bottom of the pyramid, is there still pain? Would that worry you?
So one is, all issues relating to our own economy, right? But I would say that we are doing everything to reduce the gap. We were less than 50 million household economy. Now we are talking about more than 100 million households economy, right? When we look at any investment opportunity, the addressable market has significantly expanded. But the macroeconomic risks, geopolitical risks, interlinkages. So one thing that surprises us often is, what is the interlinkage between, let's say, crude oil price increase to some of our portfolio companies. Okay. And something that is not so obvious may come and hit you, right? Or interest rate rise. See, currently, whether on the personal side or on the corporate side, our borrowings are very low. So even if interest rates have gone up a little bit, the overall dent in terms of just the rupees lakhs or rupees crores has not moved much. But we'll have to watch out for all of these trends and the interlinkages. People talk about supply chain today so fluidly, but why did we miss it in the pre-COVID era, right? So one will have to be very deep, to Srini's point, on the interlinkages of every company and how will various risks play out.
Okay, fair point. Srini, exactly that. I mean, similar question to you. How would you assess global risks of the geopolitical nature? Is that a new point that you have to watch out when you pick companies?
I think
Or is that even a positive, because that means more China plus one kind of investment?
No, sometimes that certainly does work as a positive. Whether we were the beneficiaries of cost of our human resources in the software services sector, and if you look at the services export numbers, and that's actually been a big surprise in the September quarter, and that sort of tells you something, that even though despite all the numbers that you're seeing from some of the software companies, is there something that we are missing here with regard to the services exports that is not really visible to the eye immediately. But from a geopolitics point of view, we obviously have to look at oil prices. And to my mind, given the way we have played our geopolitics as a country, I think we have done a damn good job of making sure that we are not seen to be aligned with either side, but at the same time making sure that we A, get our crude oil prices purchases right, and B, on the capital allocation side, we are not doing much wrong, and we are doing everything right to make India the possibly the most attractive destination today. I was at a conference last week in Singapore. I've been to many conferences in the past, and there were many panels that we had discussions in. The first time that practically in every panel, India got named as a country, as opposed to just being clubbed with emerging markets, which is a big positive. And, those are the strands in the wind that you catch, that that maybe this is the time.
Okay, what's the sense you're getting from foreign investors?
No, definitely India's a very, very important destination for them, and I will be very cautious about telling myself and the community I belong to not get carried away by China plus one. Nobody is going to come to India because they want to reduce their allocation to China. They'll come to India because they believe in India and the India growth story and the India return. In addition, some rebalancing of portfolio that most institutions are desirous of will give you a little more headwind. It's not going to happen merely because they need a counterbalance for China.
Okay, but which sectors are being favored now? Not necessarily by foreign, I mean, even by people like you.
Yeah.
A couple of years ago, it was all e-commerce and digital. What is the flavor now? I see you have a lot of health companies in your portfolio. You have a lot of finance companies.
Right. So healthcare has emerged as a recent favorite of most global investors. But Latha, the overall theme for India is about under-penetration and relatively much lower consumption relative to some of our peer countries as well, not even just developed countries. There we will be far away in terms of our per capita consumption. But what is more potent and relevant now is because of both our physical infrastructure development, we are able to carry our goods and services, and two, the digital infrastructure development and the comfort, confidence and trust Indian consumers have in consuming through the digital infrastructure development. It has expanded our market. Okay. And in this market, you cannot sell anything that you have. You have to make for the market. Okay. So when you're thinking about shoes in the hinterland of India, when you're thinking about selling shoes to someone who has a household income of 2 lakhs per annum, their requirement is very different from somebody who has a 40 lakhs per annum household income. So you've got to segregate the market into what is your addressable market and manufacture a physical product or a service that's appropriate for the market.
Fair point.
And because of the bite sizes in which we are able to offer them through the digital media, suddenly I would say that we have multiplied the possibilities of the economy.
Okay. Well, I'll come to sectors again a little more minutely, but before we take our break, Srini, private capital, debt capital, There seems to be a scare now that there are too many people who are giving very high risk capital. Is that one of those things which is a regulatory blind spot and may hit us?
Well, I don't think, we still haven't got enough private capital organized in the private credit space. And what do I mean by private credit space? It can be a range of return perspective, all the way from 13 to 15% for where you're providing small and medium enterprises credit who find it hard to go to the natural markets, to the high end of the risk spectrum, which is 20 to 24%, which is a bit of debt, bit of equity, what we call as hybrid strategies. So private credit, obviously, there are a lot of funds that are currently being raised. I guess this was also a trigger off from the mutual fund credit arbitrage that was taken away in the budget,
yes.
And therefore a lot of people think that they can start doing this. So whenever you have a market which is has a plethora of new fund managers that is coming in, some will succeed, some will fail. Investors have to ask the right question. But if you look at the absolute volume of capital that is required for the credit requirement of the economy, I don't think we have enough money. I think what we may...
I'm more worried, is there a system risk?
Not really. I think that's on the system risk point, it's important to understand that all of these funds are unlevered funds. Unlike in global markets, where many of the funds take leverage, we are not permitted to take leverage under the SEBI regulations. And therefore, to that extent, there is no system risk for the banking system because there's no leverage from there. However, investors need to be careful as to who they select as their fund manager.
Oh, that's a very fair point. Investors must note, both in equity and in credit, the reliability of the fund manager. We have to take a very quick break, but lots more questions for Srinivasan and Renuka in a minute after this break.